Introduction. 3 years from now, it's a Tuesday morning. You wake up, reach for your phone, and open your banking app. For a moment, your heart stops. Your paycheck is already gone. The mortgage has been deducted. The car payment has cleared. Your credit card balance is due tomorrow. You still have groceries to buy. Your child needs new school supplies. Then your phone rings. The mechanic has finished inspecting your car. The repair will cost more than you have left. You sit in silence. Not because you don't work hard, not because you're irresponsible, but because no matter how much you earn, it never seems to be enough. Now let me ask you something. What if this isn't your future, but your present? What if you've been told that the answer is simply to work harder, earn more, save more, when the real problem has nothing to do with your paycheck at all? Here's a truth that makes many people uncomfortable. The bank doesn't become wealthy because people are poor. The bank becomes wealthy because most people never learn how money actually works. For decades, you've been taught one simple rule: borrowing is dangerous. Debt is a trap. Pay cash whenever you can. Avoid loans at all costs. It sounds wise. It sounds responsible. But then a strange question appears. If debt is so dangerous, why do the world's largest companies borrow billions of dollars every single year? Why do billionaire investors finance real estate instead of paying cash? Why do banks compete to lend money to people who are already wealthy? Because there is one lesson that almost no one teaches. Debt itself is not the enemy. Ignorance is. There are two people who borrow money. One borrows to impress people. The other borrows to control assets. One becomes a slave to monthly payments. The other quietly builds financial freedom. The loan is the same. The outcome is completely different. In this audiobook, we are not going to glorify debt, and we are certainly not going to encourage reckless borrowing. This is not about buying luxury cars you cannot afford. This is not about living beyond your means. This is about understanding a financial tool that has been hiding in plain sight. Over the next hour, you'll discover why leverage has helped build some of the greatest fortunes in history. You'll learn the invisible line between debt that quietly destroys lives and debt that quietly creates wealth. You'll understand why banks think differently from consumers, why investors ask completely different questions before borrowing, and why one shift in thinking can permanently change the relationship between you, your money, and your future. Because once you stop seeing loans as chains and start seeing them as carefully designed tools, you'll never look at the financial system the same way again. Let's begin with the biggest lie most people have believed their entire lives. The lie that debt is always the problem. Chapter 1. The biggest lie you were ever told about debt. There is one sentence that has been repeated so often, most people never stop to question it. Stay away from debt. You've heard it from parents, teachers, friends, financial commentators. Perhaps you've even repeated it yourself. On the surface, it sounds like excellent advice. After all, millions of people have destroyed their financial lives through reckless borrowing, credit card debt, personal loans, car payments, luxury purchases, vacation financing. The evidence seems obvious. Debt ruins lives. But here's the question almost nobody asks. If debt is always bad, why are the wealthiest organizations on Earth drowning in it? Think about it. The world's largest corporations borrow billions of dollars every year. Real estate investors finance enormous portfolios. Successful entrepreneurs regularly raise capital instead of paying cash. Even people with hundreds of millions or billions in net worth often choose to borrow rather than spend their own money. That seems completely contradictory until you realize something profound. There isn't just one kind of debt. There are two. One quietly steals your future. The other quietly accelerates it. Most people never learn the difference. Instead, they place every loan into the same category: good, bad, safe, dangerous. Reality is far more complicated than that. Imagine two neighbors living on the same street. Both walk into the same bank. Both are approved for exactly the same loan. Both sign almost identical paperwork. On paper, their financial situation appears identical. But over the next 10 years, their lives move in opposite directions. The first neighbor uses the loan to purchase a luxury SUV. The moment the vehicle leaves the dealership, it begins losing value. Every monthly payment comes directly from their salary. Insurance, fuel, maintenance, repairs, registration. The vehicle demands money every single month. It produces nothing in return. The second neighbor borrows the same amount, but uses it as the down payment on a small rental property. Every month, a tenant helps cover the mortgage. Over time, the loan balance decreases. The property's value may grow. Rental income may increase. Instead of taking money out of their pocket, the asset begins helping put money back into it. The bank issued the same product. The interest rate may even be similar, but the financial outcome couldn't be more different. So what changed? Not the loan, the purpose, and purpose changes everything. This is where most people unknowingly lose the financial game. Consumers usually ask one question before borrowing. Can I afford the monthly payment? It feels responsible. It feels practical. But investors ask an entirely different question. Will this asset eventually pay for itself? That single question separates consumption from acquisition. One creates obligations. The other creates opportunities. The wealthy rarely celebrate borrowing itself. They celebrate what borrowed money allows them to control. Because leverage isn't really about debt. It's about control. Control over assets, control over time, control over opportunities that would otherwise take decades to reach. Imagine trying to save enough money to purchase a large apartment building entirely with cash. For most people, that could take 30, 40, or even 50 years. Now imagine using disciplined leverage to control the same opportunity much earlier, while the asset itself gradually helps repay the financing. Time has been compressed, not through luck, not through magic, but through leverage. This is why the truly wealthy think differently. They don't automatically fear borrowing. They fear borrowing without understanding. Because debt behaves like a magnifying glass. If the decision underneath is intelligent, it magnifies intelligence. If the decision underneath is careless, it magnifies mistakes. Debt never creates wisdom. It simply amplifies whatever already exists. That's why two people can take the same loan, and one builds wealth, while the other builds stress. The difference was never the bank. It was the borrower. This leads us to another uncomfortable truth. Many people spend years trying to eliminate every dollar of debt, while never asking whether the debt is actually helping or hurting them. They measure financial health by how little they owe. The wealthy often measure it differently. They ask, what is this debt allowing me to own? What return is this money creating? Does this asset produce more value than the cost of borrowing? Those questions completely transform the conversation. Because the goal isn't to borrow more, the goal is to borrow with purpose. Without purpose, debt becomes a burden. With purpose, it becomes leverage. And leverage, when paired with patience, discipline, and careful calculation, can become one of the most powerful financial tools ever created. But there's a dangerous misunderstanding waiting around the corner. Even good debt, used carelessly, can become destructive. Which raises the next critical question. If borrowing can build wealth, how do you know when leverage is helping you and when it's quietly becoming the beginning of your financial collapse? That's exactly what we'll uncover in the next chapter. Chapter 2. Borrow for ownership, never for appearance. There is an invisible line. Most people never see it, yet crossing that line determines whether debt quietly builds your future or quietly steals it. The strange part is, both sides of that line often look almost identical. The same bank, the same paperwork, the same interest rate, sometimes even the same amount of money. But one decision creates freedom. The other creates financial pressure that can last for years. The difference isn't found inside the loan agreement. It's found inside your intention. Every loan begins with a question. Why are you borrowing this money? That question sounds simple, but it reveals everything. Most people believe they borrow because they need something: a car, a vacation, a larger house, new furniture, the latest phone. But if we're honest, Many of these purchases aren't driven by necessity. They're driven by emotion, by comparison, by the desire to feel successful before becoming successful. Think about how often society rewards appearances. A luxury car receives compliments. A designer watch attracts attention. A beautiful home creates admiration. Very few people stop to ask, what sacrifices were made to create that image? Because appearances hide the monthly payments. They hide the interest. They hide the financial stress that often follows. The wealthy understand something remarkably different. They rarely borrow to improve how they look. They borrow to improve what they own. That's an entirely different game. Ownership creates options. Appearance creates expectations. One grows stronger with time. The other usually becomes more expensive. Imagine two friends who each receive approval for the exact same loan. The first immediately upgrades their lifestyle, a luxury vehicle, high-end furniture, expensive electronics. For a while, life feels exciting. Friends are impressed. Social media looks successful. Everything appears to be moving forward. But beneath the surface, nothing is producing income. Every payment depends entirely on next month's salary. The moment income slows, the entire lifestyle begins to feel heavy. Now imagine the second person. Instead of chasing a lifestyle upgrade, they acquire something that has the potential to generate value. Perhaps it's a small rental property. Perhaps it's equipment that helps launch a business. Perhaps it's a proven business with steady cash flow. Perhaps it's another productive asset. Notice something important. None of those purchases are exciting to most people. They're often invisible. Nobody applauds them. Nobody takes photographs of them. Few people even notice them. Yet year after year, those quiet decisions continue working long after the excitement has disappeared. That's one of the greatest paradoxes of wealth. The decisions that create long-term freedom rarely look impressive in the short term, while the decisions that impress people today often delay freedom tomorrow. This requires an enormous psychological shift. Consumers ask, what will this loan allow me to buy? Investors ask, what will this loan allow me to control? Control is where wealth begins. When you control an asset that produces value, time starts working with you instead of against you. The asset can appreciate, it can generate income, it can strengthen your financial position, it can create opportunities that didn't exist before. A luxury purchase does the opposite. The moment you own it, it begins asking you for more money. Insurance, maintenance, repairs, taxes, upgrades, every month. It quietly reaches back into your pocket. One loan builds momentum, the other builds obligation. This is why wealthy people become surprisingly unemotional before borrowing. They don't ask, do I deserve this? They ask, what does this produce? That single question has created countless fortunes, because production, not possession, is what changes financial lives. There's another subtle trap hiding here. Many people convince themselves that every purchase is an investment. A luxury car becomes an investment in my image. An expensive office becomes an investment in motivation. A costly vacation becomes an investment in mental health. Sometimes those explanations are true. Often, they're simply stories we tell ourselves to justify emotional decisions. Real investments don't need complicated excuses. They produce measurable value. They either create income, increase productive capacity, or strengthen future opportunities. If they don't, they're probably consumption, and consumption is perfectly acceptable, as long as it comes after wealth is built, not before. This brings us to one of the most powerful principles in finance. Never borrow to feed your ego. Borrow only when the asset has the realistic ability to strengthen your future. Because ego is expensive, ownership is profitable. The bank doesn't care which path you choose. It earns interest either way. But your future cares. Every single borrowing decision quietly asks one question. Are you buying something that works for you, or something that requires you to keep working for it? That answer, more than almost anything else, will determine whether debt becomes your servant or your master. But even when you borrow for the right reasons, another danger still remains. Many people discover leverage, become excited, and begin borrowing far beyond what they can safely control. And that's where intelligent leverage quietly transforms into financial collapse. In the next chapter, we'll explore why leverage is one of the most powerful financial tools ever created, and why too much leverage has destroyed countless fortunes. Chapter 3. Leverage is power. Over-leveraging is collapse. History has a strange way of repeating itself. The rise of great fortunes and the fall of great fortunes are often caused by the very same tool, leverage. In the hands of a disciplined investor, it accelerates progress. In the hands of an impatient one, it accelerates disaster. That is why leverage should never be viewed as either good or bad. It is simply powerful. And power has one unforgiving characteristic. It magnifies everything. If your financial foundation is strong, leverage can multiply your growth. If your foundation is weak, it exposes every crack you tried to ignore. This is where many people become dangerously overconfident. They finally understand that debt can build wealth. They experience their first success. Perhaps a rental property performs well. A business begins generating steady income. An investment appreciates faster than expected. Confidence grows. Then something subtle happens. They begin believing the success came from leverage itself, instead of the discipline behind it. That is usually where problems begin. Success has a way of convincing people that risk has disappeared. It never has. Imagine standing on solid ground. Taking one careful step forward feels safe. Taking two feels manageable. But if every successful step convinces you to run faster, eventually you stop paying attention to the edge of the cliff. Financial history is filled with stories exactly like this. Markets rise, credit becomes easy, banks approve larger loans, asset prices climb. Everyone begins believing the good times will continue forever, until they don't. When conditions change, leverage reveals who prepared and who merely hoped. Hope has never protected anyone from financial reality. Preparation has. The wealthy rarely ask, "How much can I borrow?" Instead, they ask, "How much can I safely control?" Those are completely different questions. Banks calculate what you might qualify for. Wise investors calculate what allows them to sleep peacefully at night. Because qualifying for a loan doesn't mean it's wise to accept the maximum amount. A bank's priority is simple. It wants confidence that you'll continue making payments. Your priority should be entirely different. You should protect your flexibility. Flexibility is one of the most valuable financial assets you can ever own. It gives you options when markets slow. It gives you confidence during uncertainty. It gives you time to make intelligent decisions instead of emotional ones. Without flexibility, small problems quickly become emergencies. Imagine owning 3 investment properties. Each one barely generates enough income to cover its monthly expenses. On paper, everything appears successful, until one tenant moves out. Now one mortgage must be paid from your own income. Then another property needs an expensive repair. A few months later, interest rates rise. Suddenly, what once looked like a brilliant investment now feels overwhelming. Was leverage the problem? Not really. The real problem was the absence of margin. Margin is the financial breathing room between your obligations and your resources. It is cash reserves. It is emergency savings. It is having enough flexibility to survive unexpected events without panicking. Most financial collapses don't happen because one thing goes wrong. They happen because several ordinary problems arrive at the same time. One vacancy, one repair, one medical expense, one economic slowdown. Individually, none of these events are catastrophic. Together, they can destroy someone who borrowed without preparing. This is why experienced investors assume something will eventually go wrong. Not because they're pessimistic, because reality eventually tests every financial plan. Preparation is optimism, backed by discipline. Let's talk about another misunderstanding. Many people become obsessed with appreciation. They purchase assets hoping prices will rise forever. Appreciation certainly matters, but appreciation doesn't pay this month's mortgage. Cash flow does. Cash flow is what allows an investment to survive difficult periods. Appreciation creates wealth on paper. Cash flow creates stability in real life. The strongest investments often do both. But if forced to choose, survival always comes first. Because an investment only creates long-term wealth if you can afford to keep owning it. This is why disciplined investors focus less on exciting opportunities and more on resilient ones. They ask difficult questions before borrowing. What happens if revenue falls? What happens if expenses rise? What happens if interest rates change? What happens if the economy slows? If the numbers still make sense after asking those questions, the opportunity becomes much stronger. If they don't, walking away is often the smartest investment they'll ever make. One of the greatest misconceptions about wealthy people is that they're fearless. They're not. They simply prepare differently. Fear disappears when preparation increases. Confidence grows from structure, not from optimism. Another lesson quietly separates professionals from amateurs. Never borrow because everyone else is borrowing. Financial bubbles have always been fueled by comparison. People see neighbors getting richer, friends buying investment properties, social media celebrating overnight success. And suddenly, patience feels like failure. But comparison has destroyed more fortunes than recessions ever have. The market doesn't care how quickly someone else became wealthy. Your financial life operates on your own numbers, your own reserves, your own responsibilities. The goal isn't to become wealthy the fastest. The goal is to remain wealthy the longest. Because building wealth is impressive. Keeping it is far more difficult. This brings us to one of the most important principles you'll hear throughout this audiobook. Leverage should make you stronger, never more fragile. If one unexpected event can collapse your entire financial plan, the problem isn't the economy. It isn't the bank. It isn't even the investment. It's that your foundation was never strong enough to support the weight you placed upon it. Strong investors don't build the tallest financial structures first. They build the strongest foundations because foundations aren't exciting, they're invisible, but they're the reason everything above them survives. Now that we've explored how to control leverage, another question naturally follows. Even if your borrowing is disciplined, how do you determine whether a loan is actually making you money? How can you measure, before signing the paperwork, whether an investment strengthens your financial position or quietly weakens it? The answer lies in one deceptively simple concept, a concept that almost every successful investor understands, yet very few ordinary borrowers ever calculate. It's called spread. And once you understand it, you'll never evaluate debt the same way again. Chapter 4. The hidden equation that determines whether debt makes you rich. Most people believe investing is complicated. They imagine endless spreadsheets, complex financial models, or secret formulas known only by professional investors. But the truth is surprisingly simple. Before every successful investment, there is one question, one calculation, one number. And that single number often determines whether debt becomes a wealth-building tool or a financial burden. That number is called the spread. Most people never hear this word. Yet experienced investors think about it before they think about almost anything else. Because borrowing money is only half of the equation. The other half is what that borrowed money is capable of producing. Imagine someone offers you a business opportunity. You can borrow money at an annual cost of 6%. The investment has the realistic ability to produce 12% each year. Immediately, something interesting happens. The investment isn't simply paying for itself. It is producing more than it costs to finance. That difference is where wealth begins. Now imagine the opposite. You borrow at 7%, but the asset produces only 4%. At first, the numbers don't appear dramatically different, only 3%. Most people wouldn't worry. But time has a way of turning small mathematical mistakes into enormous financial consequences. Every year, the gap quietly grows. Instead of your investment feeding you, you begin feeding your investment. Without realizing it, you've become the one subsidizing the asset. This is why successful investors rarely fall in love with opportunities. They fall in love with numbers. Emotion asks, does this look exciting? Discipline asks, Does the math work? Those are two completely different conversations. The wealthy understand that every investment tells a story, but numbers tell the truth. A beautiful apartment building, a trendy business, an exciting startup, or a rapidly growing industry, none of those guarantee success. Only sustainable mathematics can do that. This is why experienced investors never stop at projected income. They ask what remains after reality arrives: maintenance, insurance, taxes, unexpected repairs, periods without tenants, operating expenses, management costs, market slowdowns. Every one of those quietly reduces actual returns. And that's exactly why amateurs often overestimate opportunities. They calculate revenue. Professionals calculate profit. The difference between those two habits has created enormous fortunes and equally enormous losses. Let's imagine two investors once again. The first finds an investment promising extraordinary returns. Everything looks perfect. The projections are impressive. The advertisements are convincing. The seller is confident. Without asking many questions, they borrow immediately. The second investor studies the same opportunity, but instead of becoming excited, they become curious. What happens if revenue falls? What happens if expenses increase? What happens if interest rates rise before refinancing? What happens if the economy slows for 2 years? Most opportunities look attractive until difficult questions are asked. The strongest investments continue making sense after those questions have been answered. This process is called stress testing. It isn't pessimism, it's preparation. And preparation almost always outperforms optimism. One of the greatest financial mistakes people make is assuming today's conditions will last forever. Low interest rates, strong property prices, growing demand, stable employment. History tells us otherwise. Markets move, economies expand, then contract. Interest rates rise, then fall. Every financial environment eventually changes. The question isn't whether change will happen, it's whether your investment can survive when it does. That is where spread becomes more than a calculation. It becomes protection. Because a healthy spread creates room for uncertainty, a narrow spread leaves almost no margin for error. Imagine walking across a bridge suspended over a deep valley. Would you rather cross a bridge built with enormous steel beams, or one built with barely enough material to remain standing? Both may hold you today, but only one inspires confidence when the wind begins to blow. Financial structures work exactly the same way. Strong investments are designed to survive pressure, not just prosperity. There's another lesson hiding inside this idea. Many people spend enormous amounts of time searching for spectacular opportunities. They chase extraordinary returns. They dream about doubling their money quickly. But extraordinary returns often come with extraordinary uncertainty. Experienced investors frequently choose something much less exciting: consistency, because consistency compounds. Excitement rarely does. A stable investment producing reliable positive cash flow year after year often creates greater wealth than a spectacular investment that succeeds only occasionally. Slow, predictable, repeatable progress doesn't make headlines, but it quietly builds fortunes. This is also why wealthy investors don't become emotionally attached to individual assets. If the spread disappears, they're willing to walk away. Because loyalty belongs to principles, not possessions. The numbers determine the decision, not pride, not hope, not emotion. One final shift changes everything. Stop asking, how much debt do I have? Start asking, how much positive spread do my assets create? Those two questions produce entirely different financial lives. Someone may owe millions, yet own productive assets generating strong, consistent cash flow. Another person may owe nothing, yet own nothing that produces income. Who is actually in the stronger position? The answer becomes much clearer once you stop measuring debt alone and begin measuring what debt is accomplishing. Because debt itself tells you almost nothing. Spread tells you nearly everything. But even the strongest spread can be quietly destroyed by a force that affects every economy, every currency, and every person alive. A force that most people fear, while experienced investors often prepare to benefit from. That force is inflation. And in the next chapter, you'll discover why inflation quietly makes some people poorer every single year, while helping others become dramatically wealthier without working any harder. Chapter 5: Inflation, the silent force that rewards borrowers who understand it. Imagine waking up tomorrow and discovering that every dollar in your bank account can buy a little less than it could yesterday. Not because you spent it, not because someone stole it, but because the value of money itself quietly changed. That isn't fiction, it's inflation. Most people think inflation simply means higher prices. Groceries become more expensive. Gas costs more. Restaurants raise their prices. Rent keeps climbing. Life feels harder. And for millions of families, that's exactly what inflation looks like. But experienced investors often see something completely different. They don't ask, why is everything getting more expensive? They ask, what is my money becoming less valuable against? That subtle shift changes everything. Because inflation doesn't only make things cost more, it also changes the real value of debt. Imagine borrowing money today with a fixed interest rate. The payment is locked in. It doesn't change. 10 years later, you're still making the same payment, but your salary may have increased. Rental income may have increased. The value of productive assets may have increased. Meanwhile, the money you're using to repay the loan has quietly become less valuable than when you first borrowed it. Think about that carefully. You borrowed today's dollars, but you're repaying the loan with tomorrow's dollars. If inflation continues, those future dollars often have less purchasing power. In other words, the debt becomes easier to carry over time. This is one reason why many experienced investors prefer long-term, fixed-rate financing. Not because they enjoy debt, but because they understand how inflation changes the equation. Let's imagine two people. The first spends 20 years saving cash. They proudly keep every dollar sitting safely in a savings account. The second purchases a productive asset using disciplined fixed-rate financing. Year after year, inflation slowly raises construction costs. Property values gradually increase. Rental income adjusts upward. Businesses charge more for their products. Workers receive salary increases. Yet the loan payment remains exactly the same. The borrower isn't winning because inflation exists. They're benefiting because they own something that adapts, while the debt stays relatively fixed. Ownership matters. Assets often adjust. Debt may not. That difference can quietly compound for decades. But here's where many people make a dangerous mistake. They hear this idea and conclude that inflation makes all borrowing smart. It doesn't. Inflation only works in your favor if the money was used to acquire something productive. Borrowing to purchase rapidly depreciating consumer goods changes nothing. Imagine financing an expensive luxury vehicle. Inflation may reduce the real value of the loan over time, but the vehicle itself continues losing value. Maintenance becomes more expensive. Insurance becomes more expensive. Repairs become more expensive. Eventually, you're left with an aging asset that produces no income while still carrying financial obligations. Inflation didn't help. It simply made an expensive purchase slightly less expensive to repay in real terms. That's a very different outcome. Now imagine owning an apartment building. As years pass, construction costs rise, housing demand increases, rental prices gradually adjust, the building continues generating income, the fixed loan remains largely unchanged. Now inflation is working alongside you instead of against you. Notice the pattern emerging throughout this audiobook. The wealthy rarely focus on debt by itself. They focus on the relationship between debt, assets, cash flow, and time. Those four elements always move together. Remove one, and the strategy begins to weaken. Keep them aligned, and they reinforce one another. There's another lesson that often surprises people. Inflation quietly punishes people who postpone ownership forever. Every year someone waits. The asset they hope to buy may become more expensive. Construction costs increase. Land prices rise. Businesses become more valuable. Replacement costs climb. The goalpost slowly moves farther away. Meanwhile, the person waiting believes they're playing it safe. Sometimes they are, Sometimes they're simply allowing inflation to make the future more expensive than the present. Of course, none of this means rushing into every opportunity. Patience still matters. Discipline still matters. Preparation still matters. Inflation rewards intelligent ownership. It does not reward impulsive borrowing. History has shown this lesson repeatedly. Those who own productive assets often find ways to adapt. Those who hold only idle cash watch purchasing power slowly disappear. Neither outcome happens overnight. That's why inflation feels invisible. It doesn't arrive like a storm. It arrives like a slow-moving tide. Each individual wave appears harmless, but over years, the shoreline looks completely different. Perhaps the most important lesson is this: inflation is neither your enemy nor your friend. It simply amplifies the position you're already in. If you own productive assets, inflation often strengthens them. If you hold only depreciating possessions, inflation often magnifies their cost. If you leave your wealth sitting idle, inflation quietly erodes its purchasing power year after year. Understanding inflation isn't about predicting the economy. It's about positioning yourself so that economic change works with you instead of against you. Because money is always moving, prices are always changing, markets are always evolving. The question is never whether change will come. The question is whether your financial strategy is prepared when it does. And that preparation begins long before you ever sign a loan agreement. It begins with something even more valuable than money: your reputation. Because before banks lend substantial amounts of capital, they're evaluating something most people completely overlook. Not your income, not your confidence, but your credibility. In the next chapter, we'll uncover why your financial identity may be your most valuable asset, and how strong credit quietly opens doors that remain permanently closed to everyone else. Chapter 6. Your credit is more valuable than your cash. Imagine walking into two different banks. Both people standing in line are asking for the exact same loan. They have similar incomes, similar ages, similar jobs, yet one person leaves with an approval, better terms, and a lower interest rate. The other walks away disappointed, or worse, accepts expensive financing that will cost thousands more over time. What made the difference? Not luck, not charisma, not even income. It was trust. Banks are in the business of managing risk. Contrary to what many people believe, banks don't make money by saying no. They make money by lending. Every approved loan is an opportunity for profit. But before they hand over capital, they ask one silent question: can this person be trusted to manage our money responsibly? That's what your credit profile really represents. It's not a measure of your wealth. It's a measure of your financial behavior. Think of your credit history as your financial reputation. In everyday life, your reputation follows you into conversations, business opportunities, and relationships. Financially, your credit follows you into every major borrowing decision. And just like personal reputation, it isn't built overnight. It's built through consistent actions, repeated over many years. Here's where many people misunderstand the system. They believe good credit exists only so they can borrow more money. But that's not its real purpose. Good credit gives you choices. It gives you negotiating power. It gives you access to opportunities that may never become available to someone with poor financial discipline. Imagine two investors discovering the exact same property. The opportunity is excellent. The numbers work. The timing is perfect. One investor qualifies for financing quickly, the net at a competitive interest rate. The other struggles with approval, or receives financing so expensive that the investment no longer makes financial sense. The opportunity didn't disappear. Access did. This is why experienced investors protect their credit long before they actually need it. Preparation always happens before opportunity arrives, never after, because opportunities rarely wait while someone repairs years of financial mistakes. There is another misconception worth challenging. Many people believe their income alone determines financial strength. Income certainly matters, but income without credibility is limited. Someone earning a high salary while consistently missing payments may have fewer opportunities than someone earning less, but demonstrating years of responsible financial management. Banks pay attention to patterns. Patterns reveal behavior. Behavior predicts future risk. That's why consistency matters more than occasional perfection. One missed payment rarely defines a financial life. Repeated carelessness often does. This principle extends far beyond banks. Business partners observe reliability. Investors observe discipline. Employers observe responsibility. Financial credibility quietly influences far more areas of life than most people realize. Let's imagine two entrepreneurs. Both want to expand their businesses. Both need additional capital. The first has spent years treating every financial commitment seriously. Bills are paid on time. Debt remains manageable. Financial records are organized. The second entrepreneur earns similar revenue, but constantly delays payments, borrows impulsively, and ignores small financial responsibilities. When expansion opportunities arrive, who receives support first? Usually, the one whose past behavior inspires confidence. Trust compounds, just like money. There's another subtle advantage to strong credit. It reduces stress. When unexpected opportunities appear or unexpected emergencies occur, access to affordable financing can create flexibility. Flexibility allows better decisions. Desperation rarely does. This doesn't mean borrowing every time credit becomes available. In fact, one of the strongest signs of financial maturity is qualifying for credit you don't actually need, because real financial strength isn't measured by how much you can borrow. It's measured by how little you're forced to depend on borrowing. Credit should remain a tool, never become a lifeline. This distinction is critical. People trapped by debt often borrow because they have no other option. Financially disciplined people maintain strong credit, so they always have options, even when they choose not to use them. That difference changes everything. Another mistake quietly damages countless credit profiles. People underestimate small commitments. A late payment here, a forgotten bill there, an unnecessary loan application, one careless financial decision after another. Each action seems insignificant. But over time, small habits create large reputations. Just as one honest conversation doesn't build lifelong trust, one responsible payment doesn't build exceptional credit. Consistency does. This is why successful investors treat their financial reputation almost like an invisible asset. You can't see it, you can't touch it, but it quietly lowers borrowing costs, opens better opportunities, and creates financial freedom that many people never experience. Perhaps the most important lesson is this: don't build good credit because you want debt. Build good credit because you value choice. Choice allows patience. Choice allows negotiation. Choice allows intelligent decisions instead of rushed ones. And in finance, the person with more choices usually wins. But even with excellent credit, another question remains. How do you know exactly when borrowing makes sense and when paying cash is actually the smarter decision? Because despite what many people believe, the wealthiest investors don't always borrow. Sometimes they deliberately choose not to. The wisdom lies in knowing the difference. And that's exactly what we'll explore in the next chapter. Chapter 7. When should you borrow and when should you pay cash? One of the biggest misconceptions about wealthy people is that they borrow for everything. They don't. Sometimes they finance an opportunity without hesitation. Other times, they pay the entire amount in cash. At first glance, that seems inconsistent, but there is a simple principle guiding every decision. The question is never, can I borrow? The question is, should I? Those two questions lead to completely different financial lives. Many people treat financing as the default option. If the monthly payment looks affordable, they sign the paperwork. Others do the exact opposite. They refuse to borrow under any circumstances, even if doing so slows their financial progress. Interestingly, both extremes can become expensive. The wealthy usually live somewhere in the middle, not because they're indecisive, because they understand that every dollar has a job. Imagine you have enough cash to purchase a small investment property outright. You could own it immediately without making a single loan payment. That sounds ideal. But before reaching for your savings, another question deserves to be asked. What else could this money accomplish? Perhaps keeping part of your cash allows you to purchase another investment 6 months later. Perhaps it protects your business during an unexpected downturn. Perhaps it gives you the confidence to seize an opportunity no one else can afford. Cash provides more than purchasing power. It provides flexibility, and flexibility has enormous value. Now imagine the opposite situation. You borrow nearly the entire purchase price, leaving yourself with almost no emergency reserves. Everything depends on perfect conditions. Nothing can go wrong. If income slows, if expenses rise, if an unexpected opportunity appears, you have no room to respond. Too much cash invested or too much debt accumulated can both reduce flexibility. Balance matters. This is why sophisticated investors constantly think about liquidity. Liquidity simply means how quickly you can access money when you truly need it. Owning valuable assets is important, but being unable to access cash during difficult moments has destroyed many otherwise successful investors. Picture someone who owns several $1 million worth of real estate. On paper, they appear wealthy, but every property is fully committed. Every dollar is tied up. Every loan payment depends on stable income. Then the market changes. Selling quickly becomes difficult. Refinancing becomes expensive. Unexpected repairs appear. Suddenly, someone who looked financially secure feels financially trapped. The problem wasn't the assets. The problem was the absence of liquidity. Cash may not generate the highest return, but it often generates the greatest peace of mind. That's why experienced investors don't ask, "How can I invest every dollar?" They ask, "How much flexibility should I preserve?" The answer changes depending on circumstances. A stable business owner may tolerate more risk than someone whose income changes every month. A young investor may think differently than someone approaching retirement. Someone with multiple income streams may borrow differently than someone relying on a single paycheck. Financial decisions should always reflect personal reality, not someone else's strategy. This leads to another dangerous habit: copying wealthy people without understanding why they make certain decisions. You might hear that a billionaire financed a major purchase instead of paying cash. Immediately, people conclude they should do the same. But what often gets ignored is context. That billionaire may have hundreds of millions in liquid investments, several profitable businesses, multiple income streams, teams of financial advisors, access to financing unavailable to ordinary borrowers. The loan itself isn't the lesson. The reasoning behind it is: wise investors don't imitate actions, they imitate principles. Here's one principle that rarely changes. If borrowing allows your cash to earn a greater return elsewhere, financing may make sense. If borrowing only increases financial pressure, paying cash may be the wiser decision. Notice something important. The answer depends on mathematics, not emotion. Emotion whispers, "It feels safer." Mathematics asks, "What creates the strongest long-term outcome?" The two don't always agree. Another principle quietly separates experienced investors from beginners. Never allow borrowing to eliminate your ability to sleep peacefully. This sounds simple, but it's remarkably practical. If every market fluctuation creates anxiety, if every unexpected expense causes panic, if every economic headline keeps you awake, your financial structure is probably carrying more weight than it should. Money should create freedom, not constant worry. One of the greatest advantages of financial flexibility is emotional stability. Calm investors make better decisions. Panicked investors often destroy years of progress in a single emotional moment. They sell too early, borrow too aggressively, or refuse excellent opportunities because previous mistakes left them financially exhausted. Strong financial decisions are rarely made under pressure. They're made long before pressure arrives. Preparation always appears boring until the day it becomes invaluable. So when should you borrow? Borrow when the asset is productive. Borrow when the numbers remain strong. Borrow when you maintain healthy reserves. Borrow when flexibility is preserved. And most importantly, borrow only when the decision strengthens your future. instead of merely satisfying today's desires. And when should you pay cash? Pay cash when financing offers little strategic advantage. Pay cash when the opportunity cost is low. Pay cash when eliminating unnecessary risk creates greater long-term stability. Neither choice is automatically superior. Wisdom lies in understanding the difference. Because finance has never been about choosing one rule forever. It's about choosing the right tool for the right situation at the right time. Now we've explored debt, leverage, inflation, credit, and decision-making. But there's still one invisible force influencing every financial choice you make. A force far more powerful than interest rates, market cycles, or bank policies. It's your psychology. Because long before people lose money, they usually lose control of their emotions. And that's exactly where our next chapter begins. Chapter 8. The psychology that separates wealth builders from debt prisoners. Imagine two people earning exactly the same income, living in the same city, facing the same economy, paying similar interest rates. 10 years later, one has built financial freedom. The other is drowning in debt. What happened? Most people immediately search for external explanations, a better job, better timing, better investments, better luck. Sometimes those things matter, but not nearly as much as people think. Because before money becomes a financial problem, it almost always becomes a psychological one. The greatest financial battles are rarely fought inside bank accounts. They're fought inside the mind. Every financial decision begins long before money changes hands. It begins with emotion. Think back to the last major purchase you made. Did you buy it because you truly needed it, or because it made you feel something? Excitement, status, comfort, relief, hope, fear of missing out. The truth is, money rarely controls people. Emotions do. Money simply follows wherever emotions lead. This explains something fascinating. Many people know exactly what they should do financially. They understand budgeting. They understand saving. They understand investing. Yet they continue making decisions that move them further away from financial freedom. Why? Because knowledge alone rarely changes behavior. Psychology does. Consider what happens after someone receives an unexpected bonus. Very few people immediately think, how can this strengthen my future? Instead, their minds often begin imagining what they can finally buy. The vacation, the upgraded phone, the larger television, the luxury watch, the expensive dinner. The money hasn't even arrived yet, and emotion has already spent it. This is called lifestyle inflation. As income rises, expenses quietly rise alongside it. Nothing appears wrong. The apartment becomes slightly nicer. The car becomes slightly newer. The clothes become slightly more expensive. Each individual decision feels reasonable, but together they create an invisible trap. The person earns more every year, yet somehow never feels wealthier. Their income increases. Their obligations increase. Their stress remains exactly the same. This is why some people earning extraordinary salaries still live paycheck to paycheck. The problem isn't income. The problem is that every increase in income immediately becomes an increase in lifestyle. The wealthy often interrupt this cycle. Instead of asking, what can I buy? They ask, what can this money become? Those 6 words completely transform the future because money has 2 possible destinations: consumption or production. Consumption creates pleasure. Production creates possibility. Both have value, but confusing one for the other creates financial stagnation. There's another psychological trap that quietly destroys intelligent borrowing: comparison. Human beings naturally compare themselves with others. The neighbor buys a larger home. A friend purchases a luxury vehicle. Someone online appears to be living a perfect life. Without realizing it, comparison begins rewriting our financial goals. Suddenly, we're no longer making decisions based on our own future. We're reacting to someone else's present. Comparison creates urgency where none previously existed. It whispers, you're falling behind. It says, everyone else is getting ahead. It convinces people to borrow, not because the numbers make sense, but because their pride demands it. Banks don't create that pressure. Society often does, and social media has made it even louder. Every day, Millions of people compare their real financial lives to carefully edited moments from someone else's life. They see success, rarely the debt behind it. They see vacations, rarely the overtime required to afford them. They see luxury, rarely the monthly payments quietly following every purchase. Appearances tell stories. Financial statements tell the truth. Successful investors understand this. They are surprisingly comfortable looking ordinary. They don't need every purchase to announce success because they know something most people eventually discover too late. Real wealth is usually quiet. Debt often makes the loudest noise. Think about the people who truly changed their financial lives. Very few did it through dramatic moments. Most succeeded through boring consistency, making one intelligent decision, then another, month after month, year after year. Compounding isn't only a financial principle, it's a psychological one. Disciplined habits compound. Impulsive habits compound too. The direction simply depends on which habits you repeat. This is why patience has become such an undervalued financial advantage. Modern culture celebrates speed, instant delivery, instant entertainment, instant success, instant wealth. But wealth has never cared about impatience. Markets don't reward urgency. Businesses don't reward emotion. Assets don't grow faster because someone wants immediate results. Time remains one of the greatest investors you'll ever have, if you're willing to work with it instead of fighting against it. Perhaps that's why the most successful investors rarely appear rushed. They understand that opportunities come and go. Missing one opportunity rarely changes a lifetime. Destroying your financial foundation by chasing the wrong one often does. And that brings us to one final realization. Debt itself never determines your future. Leverage doesn't determine your future. Interest rates don't determine your future. Your financial psychology determines how you use every one of those tools. The loan agreement may be signed with a pen, but the decision was written much earlier, inside your habits, your beliefs, and your emotional discipline. Master your emotions, and money becomes easier to direct. Allow emotions to master you, and even the best financial strategy eventually begins to collapse. Now that we've explored the psychology behind borrowing, there is one final lesson that brings everything together. It's the principle that quietly connects debt, leverage, inflation, credit, discipline, and wealth into one complete financial philosophy. And once you understand it, you'll never think about money in the same way again. Chapter 9, The Ultimate Principle. Make money your employee, not your master. If you remember only one lesson from this entire audiobook, let it be this one. Money was never meant to be your destination. It was meant to be your tool. Yet millions of people spend their entire lives treating money as the finish line. They work harder, earn more, chase promotions, switch careers, take overtime, build businesses, not because they love the work, but because they're constantly trying to reach a number they believe will finally make them feel secure. But here's the uncomfortable truth. Financial freedom has never been about how much money passes through your hands. It's about how many systems continue working, even when you're not. That is the difference between earning money and owning money. Most people spend decades selling their time. Every dollar they earn depends on their continued effort. If they stop working, the income stops too. There is nothing wrong with honest work. In fact, every great financial journey usually begins there. The problem appears when work remains the only source of income forever, because time has limits. There are only 24 hours in a day. No matter how talented you become, you cannot create more time. This is exactly why wealthy people eventually shift their attention. Instead of asking, how can I earn more? They begin asking, how can my assets earn more? That question changes everything. Imagine planting a single fruit tree. For the first few years, it demands attention, water, care, patience. Nothing impressive happens. Someone walking past might even wonder why you bothered. But eventually, the tree begins producing fruit. Then next season, it produces again and again and again. The tree continues working, even while you're asleep. Assets behave in much the same way. A well-managed business, a productive investment, a rental property, a diversified portfolio. They require intelligence to build, discipline to maintain, patience to grow. But once established, they begin producing value beyond the hours you personally work. This is why borrowing should never be viewed as the goal. Owning productive systems is the goal. Debt is simply one possible bridge. Sometimes it's the right bridge. Sometimes it isn't. Wise people never fall in love with the bridge. They stay focused on the destination. Let's revisit everything we've learned. Debt itself is neutral. Purpose determines whether it becomes useful or destructive. Leverage can accelerate growth, but without discipline, it accelerates mistakes. Spread determines whether borrowed money is creating value or quietly draining it. Inflation rewards ownership more often than hesitation. Strong credit creates options long before opportunities appear. Liquidity protects you when life refuses to follow your plans. Psychology determines whether knowledge becomes action or remains nothing more than good intentions. Notice how every lesson points toward the same conclusion. Financial freedom isn't built from one brilliant decision. It's built from hundreds of ordinary decisions made consistently over time. There is no secret shortcut. No hidden investment available only to the wealthy. No magical financial trick. The principles have always been visible. Most people simply ignore them because they appear too simple. Consistency is rarely exciting, but consistency changes lives. Think about someone learning to play the piano. They don't become extraordinary after one practice session. They improve through thousands of small repetitions. Finance works exactly the same way. Every responsible payment strengthens trust. Every thoughtful investment strengthens your future. Every unnecessary purchase avoided creates flexibility. Every productive asset acquired expands your possibilities. Tiny decisions, repeated long enough, become extraordinary outcomes. This is also why patience deserves far more respect than it receives. Modern culture celebrates speed. The market rewards endurance. Anyone can appear successful for a short period. Remaining financially strong over decades requires an entirely different level of discipline. That discipline often looks surprisingly ordinary. Living below your means, avoiding emotional purchases, preparing for unexpected events, protecting your reputation, choosing assets over appearances, allowing time to perform the heavy lifting. None of those decisions make dramatic headlines, yet together they quietly shape remarkable financial lives. Perhaps the greatest irony is this. People often spend years searching for complicated investment strategies while ignoring the timeless principles that have created wealth for generations. Because wealth has never been built through complexity alone. It has been built through understanding, discipline, and consistency. As this audiobook comes to a close, I'd like to leave you with one final thought. The next time someone tells you that debt is always good or always bad, remember that neither statement is true. Debt is simply a tool. Just like a hammer can build a home or destroy a window, the outcome depends entirely on the hands using it. The bank cannot decide your future. The economy cannot fully determine your future. Interest rates alone cannot define your future. Every financial decision begins with one choice. Will today's decision make tomorrow easier or harder? That single question, asked consistently over many years, has separated financial freedom from financial struggle more effectively than almost any investment strategy ever invented. Because in the end, the goal was never to borrow more. The goal was never to eliminate every loan. The goal has always been to build a life where money quietly works for you, instead of demanding that you spend your entire life working for it. And when that day finally arrives, you'll realize something remarkable. True wealth was never about the amount of money you owned. It was about the amount of freedom your money created. Thank you for listening. Final reflection. The day money finally starts working for you. Before we say goodbye, I'd like you to do something. Close your eyes, just for a moment. Imagine yourself 10 years from today. Not the version of you that dreams about becoming wealthy, the version of you that became the person capable of building wealth. What do you notice? Maybe the house isn't dramatically larger. Maybe the car isn't dramatically more expensive. Maybe your life doesn't look extraordinary from the outside. But inside, everything has changed. You wake up without the constant pressure that every bill depends entirely on today's work. You no longer panic when an unexpected expense appears. You don't lose sleep every time the economy changes. You don't envy people showing expensive lifestyles online, because you finally understand something they may never learn. Freedom isn't something you buy. It's something you build, one decision at a time, one habit at a time, one investment at a time. For years, many people chase money, believing that once they reach a certain number, life will finally become peaceful. But money has never guaranteed peace. Some people earn millions, yet remain trapped by fear. Fear of losing everything, fear of falling behind, fear of not having enough. Others earn far less, yet sleep peacefully every night. Because they built systems, instead of depending only on salaries. The greatest gift money can ever give you isn't luxury, it isn't status, it isn't even comfort. It's choice. The choice to spend time with your family, the choice to say no to work that steals your peace, the choice to pursue opportunities instead of desperately accepting whatever appears, the choice to help others without first worrying whether helping them will hurt you. Choice is what financial freedom has always meant. Not yachts, not private jets, not headlines, just the quiet confidence that your future no longer depends on surviving one more paycheck. If you've listened this far, I want you to remember one final truth. You don't have to become a billionaire to begin thinking like someone who builds wealth. You don't need perfect timing. You don't need extraordinary luck. You don't need to know everything before taking your first step. What you need is a different way of thinking. The moment you stop asking, how much does this cost, and begin asking, what will this create, your financial life begins to change. The moment you stop trying to impress strangers and begin trying to strengthen your future, your priorities begin to change. The moment you realize that every dollar can either buy today's pleasure or tomorrow's freedom, your decisions begin to change. And when your decisions change, your future quietly follows. Remember, wealth is rarely built in dramatic moments. It's built in ordinary mornings, when you choose to save instead of spend, when you choose to invest instead of consume, when you choose patience instead of impulse. Those small moments rarely feel important, but years later, they become the reason your life looks completely different. So as you leave this audiobook, don't ask yourself, how can I become rich? Ask yourself a better question. What financial decision can I make today that my future self will quietly thank me for? Because that one question, asked consistently, has changed more lives than any stock tip, any market prediction, or any economic forecast ever could. The financial system isn't designed to stop you. It simply rewards those who understand how it works. Now, you understand a little more than you did before. The rest depends on the decisions you make after this moment. Thank you for spending this time with us. If this audiobook helped you see money from a different perspective, carry these lessons into your everyday life. Not all at once, just one decision at a time. Because one thoughtful decision, repeated often enough, can become an entirely different life. And perhaps, years from now, you'll look back at this very moment, not as the day you finished listening to an audiobook, but as the day you finally stopped working only for money and started teaching money to work for you.